All right, Rajiv Batra is now joining us. He's head of Asia Pacific ex-Japan and China equity strategies at JPMorgan. Rajiv, good morning. Good to have you with us here on the program. Thanks very much for your time. Just a quick view on the sort of indices and the broader markets where you've got targets. I mean, you're talking about not very aggressive numbers, but you're saying there's room for upside from here as far as the broader, larger indices are concerned. So let's get that down, and then we'll get into individual sectors and your view on earnings, etc.
Thanks for having me in show. Good morning, everyone. So we set an index target of 22,000 for Nifty this year back in November last year. And it was not just premised on the stronger growth narrative coming out of the country, but also the tailwind which we were seeing from the building Goldilocks scenario in the US and the global market environment. We anticipated by the end of the first quarter this year, 80 to 85% markets will be pricing in that Goldilocks scenario. And due to this reason why even EM markets and one which have not participated, if you remember India between the mid part of the last year was not the big outperformer. It is by the end of the year they started joining the bandwagon based on the liquidity improvement and the scenario change in the US. So we thought so by the first quarter you will get very much a front-ended return. But the next leg towards our bull case, which is a 25,000 target, you will need further new catalysts to be unleashed. One catalyst is government winning with the higher seat share, the incumbent government. That could be the one. RBI starts easing over there. And a few other sectors start joining the earnings growth bandwagon. So taking that into the discount, the base case largely is being played out. Now we are waiting for bull case to be played.
Okay, the base case is played out. Now you're waiting for the bull case to be played out. Got it. But what do you do with the broader markets? Because now in India, we are starting to see some money being taken off the table in mid and small caps, perhaps because of frothy valuations. Do you expect further pressure there?
Definitely. Sectors and the spaces, or even I will say companies that have rallied quite hard and purely premised on the future outlook without any earnings delivery for the past 3 and the fourth quarter, they will tend to react much more. Any kind of a regulatory news, which you were just highlighting earlier from the MP side, or even, let's say, any kind of a bit change in stance from the policymaker. So that's reaction we are starting going to see. But sectors which have been endlessly delivering earnings for you for the past 3, 4, or 5 quarters, they will continue to do well. Hence, the strategy should still remain run with the winner, rather than now chasing or looking at some of the laggards. So that's where our suggestion would be.
All right. Hi, Rajiv. Morning. Good to see you. We've got the base case, we've got the bull case. What could be the bear case be on the Nifty?
Interesting question. So the bear case could be if the general election result does not go in line with the expectation. That also means like the seat share count, like what market is anticipating, so investors are discounting if they get lower than that one, along with the global recession, which today nobody is discounting. The hard landing scenario is totally out of book of any of the economists at this juncture. Any geopolitical tension, if it crops up, we have been living with that for the past 2 to 3 years. But looking at market reactions, commodity markets, geopolitical tension, not at all discounted into the risk premium, especially oil prices, because if oil prices start making a comeback, India being the large oil importers may start getting a bit nervous around it. And last but not the least, any kind of a higher unemployment in the system, because that's one variable which led India start doing well over the last 18 to 24 months. So if employment numbers start going down, unemployment start rising either in urban or rural, that will be a cause of concern.
All right. Just one final question on what the expectation is going forward on a couple of these key spaces. You have been overweight on spaces like financials, autos, a lot of the rate sensitives, real estate as well. But these spaces have done very well in the last 1.5 years, especially areas like real estate and autos. Do you continue to expect a rally here, especially in the Indian markets?
So as I've highlighted that it will be very much important to take earnings into account. Valuation is the one variable which is decided by the market or by the policymakers. So what variable is under our control is earnings. So these are the spaces that has been continuously delivering on earnings. I will say in case of financial, largely it is coming from either NBFCs or SOE or you can say PSU banks, private banks have not done that. But if you look at the earnings visibility, momentum over there, auto, real estate, even the SOEs are expected to keep on delivering in terms of coming up quarters also. So if you would have seen my recent report, so we are expecting that after the tailwinds of lower input costs start getting tapered, market will look forward towards sectors and companies which have very strong good business prospect or have a balance sheet strength. When we look into this particular spaces, auto, real estate, some of the private banks, and even I will say healthcare, largely led by hospitals, fits the bill for us.
All right, Rajiv, we'll leave it there. Good conversation as always. Thank you very much for joining us, and appreciate you sort of coming on with that perspective this morning. Have you back soon again. Thank you. Our top list of stocks is lined up with our research team next. We'll take a quick commercial break here. We are back with that in just a bit. Stay with us.